The S&P 500 just posted its fifth positive month in the last 6. But as April comes to a close and stocks at near record highs, should investors adhere to the old adage, sell in May and go away? Bob Pisani is at the New York Stock Exchange with more. Bob.
This is one of Wall Street's most famous adages. You can argue about exactly why it works, but over long periods, there's something to it. Since 1950, the S&P 500 has been up about 0.4% during the May to October period, compared to a gain of 7% during the November to April period. This is according to Yale and Jeff Hirsch. They first brought this connection to light back in 1986. All right, it sounds good, but in the past 10 years, they've refined this call by layering in 2 additional factors, a technical signal and a signal based on presidential cycles. The technical signals would get you in earlier than November 1st and keep you in longer than May 1st if the market was trending up, and the opposite if the market was trending down. The other signal involves the presidential cycle. Don't sell in May in the 3rd and 4th year of the presidential election cycle when markets tend to outperform. The Hirsches claim this means you only need to make 4 trades every 4 years. Combining these 2 signals, the Hirsches claim, produces turbocharged results, an average return of a loss of 0.8% per year for the S&P since 1950 during May to October, compared to a gain of almost 10% during November to April. Translating this to money is a better way to look at it. A $10,000 investment made in 1949 from simply the May to October period would now have $4,500. That's a loss of $5,400. The same $10,000 invested in November to April would produce a gain of $2 million plus. So you can see why this hoary saw has such staying power on Wall Street. Back to you, Melissa.
Bob Pisani, thank you. So if you are worried about losses in May, how can you protect yourself? Let's get to the call to action from Professor Coe. Mike, what are you looking at?
Yeah, so if we're going to talk about insuring your portfolio, one of the things you definitely want to pay attention to is the timing of your hedges. And the reason is because hedging your portfolio comes at a cost, just like buying insurance in your car. If you do it all the time, it's going to create a drag on your returns. The next thing you want to think about is the magnitude that you're trying to hedge. Are you concerned about a big decline, or are you just looking at a potentially modest decline? And finally, one of the things you want to take a look at is volatility. That means both the volatility of the broad market and also the cost of options. So if we take a look here at the S&P, you can see what I was talking about before. Right now, you would have made money if you hedged there, maybe here, 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 and here. That's 5 times. The rest of the time, you would have just been spending some money. So that also emphasizes how important it is to focus on that timing. So now we're going to take a look at how the market has done so far, just basically over the course of the last year or so. If you can imagine that you're looking for approximately 1% returns per month, then over the course of the next 3, maybe you're hoping for 3% to the upside. So what we can do is say, all right, well, I want to have this much upside, but I want to have protection down there. And you can do that with something called a collar. And specifically, the trade we're looking at here is selling the July 245 calls. You can collect $1.35 for that, and then using those proceeds to help finance the purchase of the 230 strike put. Now, I want to make an important point, because we're looking at SPY here. They are going to be paying a dividend of about $1.18 estimated in June. So when you net out that dividend, this is actually going to cost you nothing, essentially, to insure your portfolio. So you can have 3% to the upside. Anything worse than 3% to the downside, we got you covered.
A free hedge doesn't sound too bad, Dan.
No, it doesn't. And, you know, back in the day, you know, long-short equity traders at hedge funds used to just slap on a bunch of SPY shorts, the SPY, the ETF. And I much prefer the idea of selling an out-of-the-money call, which is what Mike is doing, and using the proceeds to buy a put. That is the collar, rather than just actually selling SPY at the money. You're giving that portfolio of stocks or the SPY some room to the upside to appreciate if the market does go higher, but you also have that disaster protection below, and you didn't pay a lot for it, rather than neutralizing potential gains versus your SPY short. So I love the idea of a collar, and I like it more so on a single stock. But I get why you're doing this.
I mean, look, insurance is always good. I mean, right. that's something to. And then if one wants to go with obviously what Bob was talking about in the seasonality, there's another reason. But we also know market construction argues for it in the sense that there are fewer and fewer stocks holding things up as energy continues to falter, industrials continue to consumer, and this crowding into these very successful but perhaps overdone growth names. Market structure, seasonality, it's a good time to insure.
One quick final point about collars is that if the market does in fact take the stairs up and the elevator down, collars actually let you participate in that mild upside, but they protect you against the catastrophic crash. And so that's essentially what we're looking for here.